Warren Buffett often remarks that his favorite holding period is forever, but that doesn't always work out. A variety of reasons drive the Oracle of Omaha and his team to sell stocks regularly. In fact, only 3 of Berkshire Hathaway's 9 major stock positions from 25 years ago remain today. However, it is important to remember that there are right and wrong reasons to sell stocks. And Warren Buffett's past comments and Berkshire Hathaway's actions can help guide you in the right direction. Hello and welcome back to the Finance Guardian channel. In this video, we'll talk about the 3 times when you should sell a stock, according to the legendary investor Warren Buffett. Hit that subscribe button and the bell beside it and let's get started. Buying stocks is probably the easiest part of investing. It doesn't take much effort to click buy at the right price once you've identified an opportunity and done the due diligence necessary to determine whether a company is undervalued. Deciding when to sell is much more challenging. Even if you have a game plan when you first enter a position, there's no guarantee that the situation will remain the same throughout the trade. So you must be prepared to adapt to the changing situation as it occurs over time. It's hard to constantly reevaluate and adapt your investment plan to the changing market environment. Then there's the fact that there's no right or wrong answer. As investors, we must admit that 90% of the time the price we sell or buy at will be incorrect. Still, we should try to understand the selling process, develop our framework for buying and selling securities, and stay up to date on market movements. So the question is, when should you sell a stock? Having done your homework, you have likely purchased an excellent company at a great price, so why sell it? Just as it is difficult to determine when to buy a stock, it can be equally challenging to decide when to sell it. The last thing you want is to regret selling something too soon or too late. So I'll tell you the circumstances under which you might want to sell a stock. These are all backed by Warren Buffett and pretty much every other rule number 1 value type investor out there. Number 1. When major changes in a business's economic characteristics occur. Companies will inevitably change over time, some for the better, some for the worse. New management will often take over, new competitors will enter the market, and the very fundamentals of the company may be altered. The change can come in many forms, such as a newly appointed CEO, revised laws or regulations that affect the company, or an adjustment to the business's core mission. When the company you own no longer reflects the same company you invested in and you have no faith in its direction, it's time to sell your stock. Here are a few examples of major changes that have caused Warren Buffett to sell historically. In 2022, he sold his stakes in some of the largest airline companies, noting that the world has changed for airlines due to coronavirus. In Washington Post, one of the most important investments of all time was sold in 2014. Over the years, Buffett talked about how the world had changed for newspapers and that the Post wasn't as competitive as it was in 1973 when Berkshire bought it. Finally, he decided to let it go. There's also Buffett's investments in the grocery chain Tesco. Buffett does not specify why, but he had an issue with the management of this company, which prompted him to sell his share of the business in the end. By 2014, he had left the position realizing a small net loss. It may be argued that he should have sold back then rather than, later. However, I should point out the fundamental changes happen quite rarely. Buffett hints at this in his annual letter to Berkshire Hathaway shareholders from 1997, when he states that selling fine businesses on scary news is usually a bad decision. Number 2. When the company's price reaches its intrinsic value. As rule number 1, investors, we aim to buy companies at a discount to their true value. Fortunately, market events can often drive a company's price down to 50% or more off its true value, which makes it an excellent buying opportunity. What happens though if the price of these companies we invest in rises to the point when it equals the intrinsic value of the company? At this point, it might be time to exit your position. Sometimes the price of a company may continue to rise even after it has exceeded its intrinsic value. Selling a company at a time like this might seem like leaving money on the table. By the same token, however, holding on to an overvalued company is a risk. In such situations, a wise strategy is to sell the stock and be happy with the profits you have made, regardless of what happens to the stock in the future. Hey, you just made 50% returns. Number 3. When you're given a better opportunity. Even though it is always a good idea to have cash set aside in case a great investment opportunity arises, there may be times when you want to invest more than your cash reserves will allow. This is when it's perfectly okay to sell stock to free up capital even if the company hasn't changed fundamentally and even if the price hasn't reached its intrinsic value. That said, avoiding being sucked into a perpetual cycle of seeking greener pastures is essential. Here's an excerpt from Buffett's 1959 letter to his partners in Buffett Partnership Limited when he switched his position in a bank called Commonwealth Trust into the mapping business of Sanborn Maps. Late in the year, we were successful in finding a special situation where we could become the largest holder of an attractive price. So we sold our block of Commonwealth, obtaining $80 per share. I might mention that the buyers of the stock at $80 can expect to do quite well over the year. However, the relative undervaluation at $80 with an intrinsic value of $135 is quite different from a price of $50 with an intrinsic value of $125. And it seemed to me that our capital could better be employed in the situation which replaced it. You might have missed the mark if you followed Warren Buffett's more recent advice with regard to selling. Today, he would not sell his wholly owned business even if he expected them to deliver subpar investment returns. Listening to the advice that Buffett is a fan of holding stocks forever is a bit misleading. These days, holding forever is just a personal preference because he values and prioritizes the long-term personal relationships he has developed with the directors of Berkshire Hathaway subsidiaries over making a few extra percentages of returns. To break off relationships with people that I like and people that have joined me because they think it is a permanent home, that's Berkshire, to do that simply because someone waves a big check at me would be like selling one of my children because someone waves a big check, so I won't do that. And I want to tell my partners I won't do it so that they are not disappointed with me. The Berkshire Hathaway Owner's Manual was first presented in 1983 in an annual shareholder letter to Berkshire shareholders, but Buffett's thinking goes back much further. Here are the words he wrote in a partnership letter from 1968. As I mentioned before, we cannot make the same sort of money out of permanent ownership of controlled businesses that can be made from buying and reselling such businesses or from skilled investment in marketable securities. Nevertheless, they offer a pleasant long-term form of activity when conducted in conjunction with high-grade able people at satisfactory rates of return. It wasn't long after a chance encounter with Dempster Mill Manufacturing in the early 1960s that Buffett's preference for reselling businesses changed. Buffett was hated by pretty much the entire town for buying their largest employer and then cutting costs and jobs to make the company profitable for sale. We can, however, see what Buffett might tell us smaller investors to do if we look at his partnership letter from 1961 when he also operated with less capital. Our bread and butter business is buying undervalued securities and selling when the undervaluation is corrected. When you are motivated by emotions such as fear to sell a fantastic company, you should take a step back and logically determine whether or not selling the stock is truly the best thing to do. If you're uncertain about your investment decision, ask yourself why. Have you done your homework? In most cases, being patient and using a little logic is all that's needed to avoid selling when you shouldn't and losing money on your investment. And that's all the time we have today, folks. Is there ever a time when you should not have sold a stock? Let us know in the comments below. We hope you enjoyed this video, and if you did, please hit that like button if you're new around here. Subscribe to our channel to remain updated about all our future videos. We'll see you next time.